Welcome to Wealth Metrics. Today we have a special guest with us. Someone who has spent almost 25 years of experience in various fields of capital market, strategy, building AMCs, managing money, so vast experience of 2 decades. Sir, can you just walk us through your journey of 2 decades of building different AMCs and managing money for clients?
So thank you. First of all, thank you very much for inviting me here and especially inviting me on the Wealth Metrics podcast. Like you were kind enough to acknowledge, I actually started in the investment management industry as a summer trainee in 1999. So by qualification, I am a chemical engineer. And then, for about 1.5 years, I worked in a manufacturing factory as a production manager. Then I studied my master's in finance from NMIMS, which is in Mumbai. And then from campus itself, I joined ICICI Mutual Fund, ICICI Prudential Mutual Fund as a summer trainee. And then, got a pre-placement offer and I never looked back. Started working with them. So till 2007, I was with ICICI Prudential Mutual Fund. Then again for a year and a half, I was a project manager with this French company called AXA when they were setting up, life, general and mutual fund business in India. Then again in 2008, I joined back ICICI. There were some changes in the organization. 2008, I joined back ICICI Mutual Fund. Again, I continued there till end of 2012. So, in my formative years, if you ask me, over 2 stints, I nearly spent 12 years in ICICI Prudential Mutual Fund. I joined them as a summer trainee, management trainee. And my last role in 2012 was as their head of retail business, which entailed, managing products, distribution, sales, marketing, international business, multiple areas. End of 2012, I got roped into, lead Motilal Oswal AMC as their CEO. So I was CEO there for almost 8 years, from say end of 2012 till September 2020. And September 2020, when at WhiteOak, our founder Prashant Khemka, when we acquired an asset management company, I was roped in to set up and scale the domestic business. So from 2020 till as we speak, last 5 years, I've been CEO for WhiteOak Capital Asset Management. It's been exciting. I think the best part about my work is I end up meeting a lot of investors, end up meeting a lot of channel partners. I travel a lot. At the same time, all of us are blessed to be in a country, in an economy, in an industry, which has been growing at a rapid pace. And even now it is exciting because as we understand, the best is still in front of us. What we've seen till now is only just scratch the surface. What is exciting is that the best is yet in front of us. Long back, one of my bosses, he told me that, the best of businessmen needs a tailwind, right? And all of us have been, our investors, ourselves, all of us, thankfully we've been in a tailwinded environment for quite long. And it is exciting to know that it's going to sustain for some more time to come.
Yeah, that is exciting. But as you rightly said, many of investors are thinking that investing is more about economics, finance, and analyzing a lot of technicalities. Yeah. But I've heard that you are speaking so loudly about emotional aspects of it.
Yeah.
Right. So can you guide us through how emotional aspects is driving much better or much greater than your technical skills or your technical analysis about it?
So, it's a fact that when you look at fund management, mutual funds, portfolio management, alternate funds, when you look at business TV, correct? If you look at all of that and all the people who come there and speak there, you will get an impression that it is all about the economics, the science, the finance and the math, right? It is true, it is technical, correct? And people like us, who are dealing with clients, dealing with portfolio managers, managing money, dealing with markets, dealing with regulation, it's a fact that, someone like me is sitting at an intersection of many functions, right? Intersection of technology, regulations, finance, economics, a lot of technical aspects. So it is complicated, and if somebody thinks that it is all about science and maths and economics, then maybe they are right, they're not wrong. But we should step back and not forget that in the last 20 years, at least twice, the Nobel Prize of Economics has been awarded to people who study human behavior or human psychology. Correct? Now, as you'll appreciate, Sibi, that the economics that we have been taught, in that economics we were told to assume that human beings are rational and logical. You know, like for example, you are taught, you were always taught that when the price goes down, demand will go up. And when the price goes up, the demand will go down. That's a sign of rationality. That's a sign of logical thinking. So economics actually presupposes that human beings are rational and logical. And people who study human behavior or human psychology, they can never make that assumption that human beings are rational and logical, right? So something which is polar opposite. How can the Nobel Prize of Economics, where the presupposition is that human beings are rational and logical, for such a field, how can the Nobel Prize be given to somebody whose basic presupposition is that human beings are emotional? Correct? So it's obvious that human behavior and human emotions has far-reaching impact on how actually economics and finance and stock market will actually play out, right? And it is factually true that in the stock market also, it doesn't happen that when prices go down, demand goes up. In fact, in the stock market, it is repeatedly seen that when prices go up, people queue up to buy even more, and when prices go down, people start getting very, very disenchanted and disappointed. Mr. Buffett is said to have, quoted that, "Be greedy when others are fearful. Be fearful when others are greedy." So how come the world's most successful investors, most successful mantra is about emotion and not about finance? Mr. Buffett is not quoted most widely or most famously for saying that you should buy companies with ROIC more than 20%. He is not quoted for saying that you should buy companies with huge amount of free cash flow, right? Yes, he said you should buy companies with economic moats, etc. But that is not his most famous statement. His most famous statement is about emotions, that for success, you should control your emotions. So that's a fact that, most people who come into the market think that they need to be some economics or finance guru. But in reality, that you may just be knowing basics of economics and finance, but in terms of your behavior, in terms of your emotional conduct when you're participating in the market, you could be far more mature, right? And when others are being greedy, you are being fearful, and when others are being fearful, you are being greedy, which means you are never part of the others. You have the guts and the emotional strength to be away from the crowd. You have the guts and the emotional strength to be away from the herd and to do something differently, right? As recently as 1 year back, when Nifty was 26,200, everybody must be telling you that I want to put money in a small cap fund or a defense fund. Now 1 year later, the economic growth has been upgraded, sovereign rating is upgraded, interest rates are down, taxes have been cut, and Nifty is still lower.
5-6% lower than
it's lower, right? Last year when so much of the scenarios were worse and Nifty was 26,200, people wanted to buy the most aggressive stocks and funds. Today when Nifty is lower and the environment has actually improved, now people are having doubts whether to invest or not. So it's the emotion which matters, not so much the mathematics.
Yeah, one thing comes to my mind immediately, as you said about emotions, and now people are not putting money into the market so aggressively compared to the last year.
Yeah.
So nowadays, most of them are speaking about investing in gold, given the rally last year and the underperformance of equity last 1 year. So this is a clear example of how emotions are driving each one of them.
Yes, of course. So, look at it this way. How many people told you 2 years back that I want to buy gold? That's the whole question, right? So the point is that the time to buy gold was probably 2 years back. Now, well, yes, I agree that till the time people have doubt on US economy, till the time people have doubt on US economic conduct itself, till the time we all are worried about the geopolitics, from time to time gold and silver and oil and Bitcoin and all the alternative asset classes, from time to time they will make headlines because people are very uncertain about the traditional asset classes. But for example, if money starts moving, if some of the tariff related issue or if some of the geopolitics is taken care of, then money will start moving to emerging market currencies and money will start moving to emerging market stock markets. then probably gold and silver will not be as salient as what it is right now. So what happens is that 2 years back, like we ourselves created a fund which put a lot of money in gold 2 years back, example. At that time people were telling us that why are you owning 20-25% gold? It doesn't give any return. What are you trying to do? Now when it has actually played out, then it is being recognized. But now probably we ourselves are reducing gold and shifting into equity when everybody is talking about gold. Correct? So I think, in English there is a proverb. I mean, just take it as a proverb or a metaphor. It is not a disrespect or a carelessness for animals, but there is a proverb which says that you have to shoot where the rabbit will be. Of course, you and me are not going out shooting rabbits. Take it as a metaphor, but you have to shoot where the rabbit will be. Because rabbit is obviously a very agile kind of animal, right? If you aim at a rabbit and shoot where it is, the moment it hears the sound, it's going to scoot. So if at all you are going to aim or hunt down a rabbit, you have to shoot where it is likely to shoot in the direction which it is likely to move. Today, if you feel like loading up on gold, you are shooting where the rabbit was 2 years back. So with all the things about the current environment, maybe for some time it will remain salient, like I said, but eventually you have to start looking at Indian equities and emerging market equities rather than looking at gold, which was probably more relevant couple of years back.
So it gives me immense pleasure and proud to say you that WealthMetrics and its clients, we allocated almost 20% of the portfolios into the multi-asset, where you mentioned about 25% is gold 2 years back.
Oh, kudos. Maybe you're one of the few ones who would have recognized it probably.
Yeah, correctly, exactly. We were thinking about the equity valuations and valuations went a lot.
Higher,
and we also wanted to make it play it little safe. We ourselves didn't think that gold will run this fast or
that you cannot predict, but you have to make a relative call. Yes.
Yeah, it's a relative call. We did it, and fortunately it worked extremely well for WealthMetrics and all of our clients.
Of course, fabulous.
So next I just want to think about, now we are in Kerala, especially in Kochi. So you might have heard about Kerala. It's the financially the most literate state in India. But unfortunately, the Malayalis, they allocate a lot of their wealth into real estate and gold, predominantly real estate. So when we done a research study, 70-75% of all of Malayalis' net worth is tied up with real estate. So when you think about the asset allocation point of view, the equity is the more minute portion of their asset allocation. So how do you see that? How can we bring that behavioral change to the as a society?
See, I think that it's not, Kerala, I can understand, you will know more than me, but you know what, Sibin, last week I was in Hyderabad, and in Hyderabad also people say the same thing, that they have a lot of money tied up in land, and land around Hyderabad and, in real estate. And I believe that is true probably even for Gurgaon and maybe even for Ahmedabad and Jaipur. And I think that in various parts of the country, there is definitely this huge infatuation with owning a lot of real estate. But I think that, and I don't think there is anything wrong in having real estate as an asset class. But there are 2 or 3 issues, and there is no criticism. I myself invest in real estate. So I will not, I'm not saying anything with any biased perspective. Being an equity guy with 26 years in the equity market, I also invest in real estate. So no bias. But still I will tell you that if you are saying that somebody has 70-80% of their net worth in real estate, then there are few things that one has to really think about. First thing is that when you invest in equity, especially when you invest in an equity mutual fund, and you are a wealth manager, you know this more than anybody else, that when you show the performance of an equity mutual fund to your client, it comes very naturally to them that they will see the CAGR, compounded annual growth rate. They will never tell you that, oh my God, I have put 100 rupees 5 years back and fantastic, it has become 200. It's 14% compounded. Right? In a mutual fund, you will clearly see. But in land and all, no, people don't see CAGR. The second thing is that it is absolutely regulatorily compulsory that when we show you the performance of our mutual fund, we have to show the performance of the index also. Correct? So what happens? Somebody will buy land 5 years back, 100 will become 200 or something, or maybe even more. That's fine. But then they'll feel very happy. And then you say that, no sir, your neighbor's plot has gone up, your plot has gone up 2 times, neighbor and all the others' plot has gone up 3 times. You've done a bad job. In a mutual fund, that is very, very evident. If the whole city land appreciates by 20% and you are holding a plot which appreciated 10%, then you have done a horrible job actually. There's nothing to be proud about. In the mutual funds, such a confusion never happens, because wherever you see our performance, it is with a performance of the index, and our performance versus our competitors' performance is widely available. There is no scope for confusion, right? Third thing which happens is that when it comes to land, people don't seem to realize that you cannot, while you are holding it, it may not produce returns, or it may produce suboptimal returns in terms of the income. It's not liquid, right? You may be having 10-20 crore worth of property, but you need 50 lakh rupees. What can you do about it? You can't do anything about it, right? So there are many of these challenges. Last thing is transmission, right? Something happens to me, I need my property to go to my kids. If it is a mutual fund or a demat account, it's easy, right? With land, I think so many complications can come up. So I think that if we are bullish about the economy, see, why do we tell people to invest in equity? I would never tell anybody to invest in equity unless I was bullish about the economy. So I am bullish about the economy. If I am bullish about the economy and I am bullish about equity, then real estate is a big factor of production. You cannot be positive on the economy but negative on real estate. Yeah, it depends whether you're buying commercial, residential, warehouse, hotel, hospital, what you're buying, it matters. But ultimately, real estate is a big factor of production. And if the economy is booming, if the people's earnings are growing, then real estate will do well. But it cannot be 70% of the portfolio now. You have to be mindful of all the nuances that we just spoke about. The most important thing, please learn to calculate the CAGR, and please learn to compare it with the right benchmark.
Yeah, I also always feel that the same thing, the calculation of CAGR. In financial assets, including all the financial assets, people always compare with the CAGR.
Yeah.
But in terms of physical asset, especially gold or even gold and real estate, people always compare the absolute value.
But CB, even in equity, there is one such challenge. Even if you see somebody's demat account, a demat statement doesn't have CAGR or IRR, and a demat statement also does not have index return. So even when people are owning direct equity, the best of guys, rich people, smart people, very intelligent, even when it comes to direct equity, they will say, you know what, I bought this stock at 100 rupees, now it is 200. See what a great job I have done. You say, boss, that much return index is also given. That much more than that return another 100 stocks have given. Our mutual fund has given more than that, for example. So even in individual stocks, sometimes I find that people are not computing the CAGR and people are not comparing with index. They are dealing in anecdotes. So basically what I find is that real estate and direct equity, generally people are dealing in anecdotes rather than a scientifically disclosed data. That, I think now the point is whichever investment you look at, other than your own residence and other than your wife and mother's jewelry, everything else should be calculated like it's a investment, and you should be scientifically seeing it objectively.
Since you mentioned about direct equity, and just want to clarify one thing, for those who try to do directly, do it yourself investors.
Yes.
So when one argument they used to say to us is that when we invest especially mutual fund, PMS, all the structured product, ultimately they invest in equity and they take a management fee.
Okay.
So why can't we directly invest, and why can't we save that money also? So that our portfolio will be much better than many of these structured portfolios.
So there is no end to that argument, right? That applies to practically everything under the sun, right? Meaning that why only direct equity and why only the management fee of a mutual fund? The point is, first let me clarify that if a mutual fund is doing better than the index, and after you have scientifically computed the CAGR of your own direct equity portfolio, whatever CAGR you are getting, if you find that there is a plethora of mutual funds, which is maybe they have taken fees, but after taking fees also, if that plethora of mutual funds is doing better than your direct equity portfolio, then why not? You're concerned with you getting a good outcome, or you're concerned with me not getting a fee? What is your priority? My funda is very simple. If you get me good service and good outcomes, I am willing to pay the fee, is not my concern. Without your help, if I am going to be worse off, then logically I should be willing to pay you a fee. Now I understand, we already spoke that human beings are not logical, so I understand that. But that much logic you have to apply everywhere, no? So in that sense, though, of course, you know, you will be fighting your own cases in the court, and you will be filing your own tax returns, and you will be paying your own GST filing, and you know, you will be self-medicating yourself, and you will never go to a doctor or a lawyer or a CA or a beautician or an interior designer or an architect or a tailor or anybody for that matter, right? I mean, you can just buy, there's no end to that logic. Should I buy cloth or should I stitch my own cloth? Correct.
So I often feel that this is one industry, you'll get the expert service at a very, very nominal cost.
Yes.
In terms of percentage, if you consider. So if you are getting a Virat Kohli to play for you, instead of you try to yourself playing it for, if you can hire a Virat Kohli at a nominal cost, so that's why you are getting a fund manager.
And that too, depending on the pitch and depending on the situation, you can get the right schemes or the right fund managers or the right players. You have enough choices available. Lastly, if you really think that you have become expert yourself, then of course there will be some people, it's not like nobody is capable, there will be some people who will be capable of doing DIY, so they should do DIY, no problem.
Yeah, we are talking about massively about
yes,
the retail
but
investors.
but for the public at large, different service providers play different roles in your life, so you should see which service provider is adding value to you.
Okay, now we talked about the emotions and doing it and everything. So somebody is massively aspirant. So somebody wants to create a retirement portfolio of maybe 50 to 100 crores. So how should they allocate their asset allocation? How should be the asset allocation look like?
See, it's like this. I mean, you have 20 crores right now and you want to make it 50, or you have 5 crores right now and you want to make it 50. The
Maybe
journey is different, right? Because, you know, we need to know 3-4 things. If we want to make a journey, we need to know from where to where we are going. We need to know when do we need to reach there. We need to know, do we have any time limit of reaching there? We need to know how fast we can drive and what kind of risk we can take along the way. We need to know, do we have to go in one contiguous journey or we are willing to take some breaks in between and enjoy the scenery also, right? So there are many considerations in this. But if you really ask me, for anybody who wants to build a big, wealth creation, retirement corpus, equity is the way to go. But within equity also, if you save the maximum possible that you can, right? Again, Mr. Buffett has said that income minus saving is equal to expense, not income minus expense is equal to saving. If your lifestyle is such that income minus expense is equal to saving, then you are left to the mercy of your whims and fancies and temptations and exigencies. But if you are disciplined that income minus saving is equal to expense, then you are prioritizing your saving and your corpus building, and only what you can frugally spend is what you are spending. So being frugal, being wise in your judgment, not pandering to exigencies and emotions and desires and all that is very important. Our market has a great history. In last 32 years, Sensex itself has compounded 14-15%. So Sensex itself on an average has doubled every 5 years. So we are blessed to be in an economy and a market which is growing at a particular rate. Correct? Now it is for us to participate and maximize. So how much you invest, how consistently, for how long, and what rate you are able to fetch, that is the key.
So I am reminded of once Warren Buffett being asked about what you considered as your biggest leg. So he was telling that he was able to born and live in the golden era of US. That is considered as his biggest leg. Absolutely. I often feel that we are in the same era considered to India.
No doubt about it.
But still, when we talk about a lot of Gen Zs, especially in today's generation, so they are very much highly about their YOLO factor. Have you heard about it? The YOLO factor.
You live only once. Yeah, you only live once.
In their books, in their lifestyle, the scope for saving is very less. Yeah. So they are more or less they believe in the you only will live once. So why can't you enjoy it to the fullest extent? So what is your advice to that kind of generation?
No. I would just say that I am nobody to advise anybody. Everybody will have their own priorities, and everybody. I think, generally speaking, people are smart. They know what they are doing. I never come from a approach that people don't know what they're doing, or that people are careless. I don't have any such assumption, and I wouldn't advise anybody. But I would just point out that when you said that acronym, you only live once, I would just say that please remember that lifetimes are becoming elongated, right? I am now nearing 50. I suspect, I mean, like right now, what is the average life expectancy for males? It's 72 years in India, right? But I am 50, and I believe that people who are my age will end up, the average life expectancy will go up. So I believe that people of my age might end up living 80, 82, 85, something like that, I don't know. But people who are younger than me, say 25 years old, 30 years old, they are most likely to live 100. And there is actually, I have read this kind of literature which says that by the year 2035, it's quite likely that kidneys will be grown in laboratories. And it's quite likely that medical science will just not let you die. For a cost, you will be able to live for quite long. For a fact that Mr. Elon Musk is building, Neuralink, correct? So there are a lot of people who have some kind of brain damage or some kind of challenges. By inserting certain chips which can give certain impulses to your brain, you will overcome the deficiencies of your brain. So YOLO is fine, but you are going to live 100 years. So then, in 100 years, there are many lifetimes and many decades and many changes which will happen. So you have to plan, I think that is very important.
Planning to live longer.
Yeah, you have to plan for live longer. If you have to plan for live longer, then how you plan your finances, how you plan your career and profession. Like for example, I believe that, say I have had 26 years of the same career and I worked in 3 companies more or less. 20 years down the line, maybe I might be having a different career, or people who are younger than me in one career span, they might be having 3 different careers. Because the world will change faster than what it has been changing of late till now, right? So when I said that people who believe in YOLO, YOLO, they should keep in mind that they're going to live 100 years and there'll be many junctures and many journeys within those 100 years. So you have to plan not just your finances, your health, your profession, financial planning itself. YOLO is basically, make the best of today, make the best of the opportunities. But your life or the world will not come to an end by the time you are 30 or 35. You will live 100. So you have to be careful.
Since we all know Kerala is our maximum number of NRIs also. So most of our audience might be interested to know more about the GIFT City options, so
Certainly.
that they can invest through, how they can invest through GIFT City, and what is the advantages of investing in GIFT City from an NRI point of view.
Yeah. See, GIFT City is a fabulous kind of, offshore center created by the government. In fact, if you really ask me, NRIs who are investing in India, especially in India's stock market and Indian mutual funds, I personally feel that they should invest only and only through GIFT City. There is no more reason to invest locally through your NRE account and through the local banks. Because you and me all know very well that locally, if an NRI, they are investing, they are sending money in dollars, doing remittance, putting it in the India's banking system, in an NRE account. Of course, it is repatriable. But if you make an investment out here, then when your investment is redeemed, you buy and sell some shares, then every redemption, every buy-sell transaction, there will be TDS, correct? And then of course you'll have to file taxes here, and then that TDS will be set off, etc., etc. There is friction related to banking system and TDS and tax filing and those kinds of things. But if you invest in GIFT City, let's say you are in Dubai or Muscat or Middle East or wherever you are, right? Malaysia or Singapore, whatever. If you invest through GIFT City, there are two or three benefits. First thing is that if you invest as an NRE, there is tax on redemption, there is TDS, what we spoke about. The same investment sitting in Dubai, Muscat or wherever you are, if you invest in a GIFT City fund, so obviously from your whatever bank account you have there, you will remit money in dollars to GIFT City. Now let us say we have a multi-cap fund here. In GIFT City, what we have done, we have created a fund which collects money from foreigners and NRIs, collects money in GIFT City. And from GIFT City, what do? We put money in the very same multi-cap fund in which you might be investing local money. So you put money in GIFT City, the GIFT City fund puts money in the multi-cap fund. Now, If you invest in the multi-cap fund and you redeem, you have capital gains tax. But when you redeem in the Gift City fund, what will the Gift City fund do? It will remove money from this multi-cap fund and process your redemption. When the Gift City fund redeems from our multi-cap fund, in Gift City that fund pays no tax. And then, so what happens? The multi-cap fund here, anyway buying, selling, no tax, because mutual funds are tax exempt. On redemption there is tax. But if a Gift City fund is redeeming from here, in Gift City it is not paying any tax. So the tax which you would have otherwise incurred and the TDS which you would have otherwise incurred is completely free, out of the picture. There is no tax. Now from Gift City, when the money will obviously be, the redemption will be processed, the money will be remitted to you into wherever your account is, Dubai, Muscat, wherever. Obviously in Dubai, for example, in UAE, there is no capital gains tax. In Singapore, there is no capital gains tax. So what has happened? If you invested locally in India, you would have capital gains tax and TDS and tax filing. But if you invest through Gift City, no capital gains tax, no TDS, no tax filing. And when the Gift City fund pays to you, you anyway don't have tax. So you are two things, no operational friction and no capital gains tax. So I don't see any reason that if NRIs are going to invest in Indian mutual funds, there's no reason anymore to invest locally. You are much better off doing in Gift City only.
So they will be able to take advantage of the tax benefit also.
There is a tax benefit, yes. There is a tax benefit and there is operational convenience. Tax benefit is important, but that comes on redemption. But at least the operational convenience is much higher.
So nowadays, since we spoke about people are about looking to live longer, and also you know that since India is in a developing stage, the inflation is also compared to the rest of the world. And the third thing I just want to ask you about the healthcare and education cost is not part of our inflation index also.
Yeah.
So considering those facts, people are literally talking about 8, 9 and close to 10% kind of inflation if you account those factors also. So for those who want to plan for their retirement life without compromising their present lifestyle, so how should someone plan, and what should be the ideal kind of equity allocation for their retirement portfolio?
See, I think there is 2, 3 things I want to clarify. First is, retirement planning is not for retired people. Retirement planning has to be done by 30-year-olds and 35-year-olds and 40-year-olds. You cannot plan for your retirement 5 years before you retire or after your retirement. So I just it might sound that I am talking something very simple, but it's not so simple. Most people don't realize this, that retirement planning is not for retired people. It is for young people to prepare when they are 30, 35 or 40. Right? The earlier you start planning, the better it is. That is first thing. Second misnomer or misunderstanding is that if people are retired, they should not invest in equity. Or you know that there is another misnomer, which is that 100 minus your age is your equity allocation. So if you are 60-year-old, then your equity allocation should be only 40. All of these are misunderstandings. We just spoke that even if you're 60-year-old, you have to plan to live 80 or 90 or 100, no. So you cannot just finish away your money. You will still, even if you're retired and even if you have some monthly income required, you still need some corpus which will be dedicated to growing and preparing for what if you live 90 or 100. Even if you live less, wouldn't you want to give an inheritance to your grandkids or to your kids, correct? So I think that even if you're retired, you still need your portfolio to grow. So the way to look at is that, okay, if you're retired, don't put equity, or 100 minus age is equal to equity. All of those things should be chucked out of the window. Basically, you should keep in mind that how much money you need every month to sustain and how much money you need to keep aside for any medical exigency or any foreign trips or any breaks or vacations. That is how you need to start thinking. So let us say that I need 2 lakh rupees per month, example, which is 24 lakhs a year. Okay. Let us say that if I have a retirement corpus, say, just throwing a number, say 10 crores, example, right? So 24 lakh rupees per year I require. Okay. Now, if I have put actually, let us say that if I put 6 crore rupees or say 5 crore rupees in a way that it produces, even with very little withdrawal, it produces 2 lakh rupees per month for me. So I should put 4-5 crores in such a way that it will give me 2 lakh rupees per month. Yeah, and you need to do the exact calculation, because say, at a rate of 8% if you withdraw, then say if you withdraw at the rate of 8% and it is 24 lakhs, so 12 times. So say something like 3.5 crores will give you 24 lakhs per year. So if I put 3.5 crores to give me 24 lakhs per year as a withdrawal, then I am left with 6.5 crores, which is because I started with corpus of 10. That 6.5 has to be invested for growth only, no? So somebody may start with a corpus of 2 crore, 5 crore, 10 crore, whatever the corpus may be, I don't know. But the point is, whatever your corpus is, first you need to set aside something which will generate monthly income for you. And the corpus which you require to generate your monthly income, that has to be conservative or hybrid. It cannot be fully into equity. The corpus which is excess after taking care of your monthly requirement, that corpus you should grow for further, you should invest for further growth, right? So it has to be scientifically computed. We cannot take shortcuts like, okay, if I am retired, I will not do equity, or I will see what is my age. It's not like that. You have to have a scientific calculation, and at any age you may be, you still need to help the money to grow. If I become too conservative and I live to 100, then what will happen? It will be very difficult. So I think it has to be actively managed and it has to be well planned and calculated.
Thank you, sir, for making such a wise conversation for our clients and audience. So we hope that the conversation will be beneficial for all of us. And extremely thank you, Aashish sir, for spending a lot of, especially from your experience, sharing a lot of wisdom with our audience also.
Thank you to you and Wealth Matrix. Best of luck to all your clients and viewers. Thank you.
Thank you so much.